It's time to address personal finance in our personal finance corner. Faye, what's up for discussion?
Well, Aisha, we know that the retail investor completely stayed away from the Diwali rally and he's still not convinced. So we're going to ask Dhirendra Kumar what his advice is. Let's bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us. Now, we know the retail investor has been conspicuous in his absence in the recent rally in our stock market, mainly because the argument they offer is that the market doesn't seem to have really moved in the last 5 years. What advice do you have for investors who are shying away from equity right now?
You don't have a choice. I don't think there is anything that has happened in the market in the last 5 years which can make investors cheerful. But markets have been disappointing. But I think at the same time, this has been a market where investors should have been investing regularly. They should not be giving up on their hope. They should not be giving up right now, simply because and I don't think this market is growing on a framework which could be very sustainable. But at the same time, I'm extremely hopeful about the market in next 3 to 5 years time frame. And with that perspective, investors have very simple things. Why investors have not been very enthusiastic about the equity market. One, they haven't got any meaningful return. Last time when they came in large number, the first time investor with a lump sum investment in the infrastructure fund, they have reason to be extremely disappointed. But I don't think that's the way to start for any individual investor getting started. So you have very simple principles to follow. Invest regularly, don't make lump sum investment, diversify your portfolio. And most investors did not do that. I think investors will start chasing performance once again, which may be a very undesirable way to get started. But for select investors, I think they have reason to be very cheerful. Market has gone up a little bit, however narrowly, and so don't give up on equity. You don't have a choice.
But Dhirendra, my next question to you is about mid and small cap funds. Now, for those of us in these funds, we weren't touched by that rally at all. It was limited largely to certain blue chip large caps. Now, should we continue to have faith in our mid and small cap funds at all? Some of them have given returns of about 1% over the last year. Or is it time to pull our money out and maybe just focus on the index?
I don't think investors should be guided by which part of the market is performing. You should be guided more by what kind of ups and downs or the scale of up and down which you are comfortable with. If you are a first time investor, never invested in anything which has gone down, which can potentially go down in value, I think, and you are a long term investor, make sure that you are getting started with a balanced fund, or maybe more conservative investors should be getting started with MIPs in the growth option. So you will have a limited exposure to equity. And likewise, if you're comfortable, then be with an all cap, a multi cap fund, or maybe a small and mid cap fund. If you're fine with big ups and downs, and you should not be, my sense is that don't be guided by this large cap orientation today, because and the best in mid and small caps has yet to come, and it may not come in a hurry. Because right now the market is entirely driven by FII's inflows, and this may not be a very sustainable driver for the market. So you should have patience, and I think that multi-baggers in India will be in the mid and small caps, will be there only. Large caps are unlikely to be multi-baggers from here on.
All right, Dhirendra, many thanks for joining us on the show this afternoon.